Welcome to the Credit Events Podcast, a podcast for credit-savvy investors. This podcast is for informational and educational purposes only and does not constitute financial advice. The opinions expressed by the presenters are their own and do not reflect the views of Destra Capital Management. Nothing discussed in this podcast should be considered a solicitation to buy or sell any securities. Listeners are encouraged to consult with a qualified professional before making any financial decisions. And now, here's your host, Rob Watson.
Hello and welcome to Credit Events. I'm Rob Watson from Destra Capital and I'm your host. Today we're talking with Mark Scalzo, Chief Investment Officer and Portfolio Manager at Validex Global Investors. Mark, welcome to Credit Events.
It's great to be here, Rob.
Mark, you and your team at Validex are prolific bloggers, and I got to say, I read everything you put out. It's always interesting and insightful, but the thing that, frankly, I like the most is that you get right to the point, and you usually shorten your blogs. My attention span fits that, so I appreciate it. You guys put out a blog just a couple weeks ago called Bubbles, Private Investing, and Crypto, Oh My. And I thought you just captured almost everything that the market's fixated on in one blog. So I got to ask you, why credit investing, and what do you see that's fascinating about it today?
Well, credit investing is just a part of what we do, but I think any good investor, whether you're an equity investor, alternative investor, whatever it might be, you should understand credit. And you should understand how credit applies to changes in the values of companies that are based on that credit. And so, I think it's always a good idea to keep in mind one of the things that we do. For instance, when we look at an equity investment, is we have a pillar in our validation process that's focused on balance sheet strength. And we consider the change in default probabilities as an indicator of the current perception of credit quality and balance sheet strength when we invest in those equities. Because the bond market, usually, not always, but the bond market generally indicates that there's a problem before equity investors see it. So we think it's kind of a key element to understanding investments regardless of what asset class you specialize in.
Yeah, that's an old adage that you referenced there about the bond market being ahead of the stock market, at least.
Not always true, but I think it's true a lot of the time.
A lot of advisors and investors will hear credit and just think, oh, it's just boring yield. What might be a blind spot from that view?
Well, I think it's when you think about credit in the overall pantheon of fixed income. For us, I think it really leverages our, we're always focused more on the specific. So it kind of leverages that specific mindset. We think we can understand a company. We can understand the credit dynamics of a company. A lot harder to understand the credit dynamics of a country or a global economy. So we've always been proponents of not trying to make top-down macro calls, but more bottom-up individual security decisions. And so it's a lot easier to understand and underwrite a credit of an individual company or a credit related to a specific transaction, for instance, like in a merger or an acquisition. And it's, as we can see from economists over many, many, many years, it's harder to make those top-down macro calls. I think our mutual friends at Blue Bay kind of feast on this a little bit because they understand circumstance-specific complex credit issues, and that gives them the opportunity to earn above-market yields rather than trying to forecast where interest rates are going or other factors like that. So one of the things that we do is we also advise on asset allocation portfolios for certain clients, and we've been much more focused on trying to find absolute return strategies, alternative ways of generating income and lowering duration risk, and we've also been favoring floating rate debt, even as rates were coming down. Because it's really hard, and you can see, it's really hard to forecast that, and they've gone back up, and now we're higher for longer. So because of that, we want to try to insulate ourselves as much as we can On the equity side, we're looking for companies that can grow regardless of the macro environment. And on the credit side, we're looking companies that can continually service that yield in a responsible way, regardless of the market environment.
Mark, you talked a little bit about sort of the cross-asset or multi-asset mandates that your team at Validex deals with. I've seen some of your blogs where you touch on CLOs and private credit and other instruments. CLOs can sometimes get a bad rap because there's some complexity in the structuring of them. There's a lot of perceived risk. Are there any myths or mistakes you think investors might make out there if they just overlook CLOs because they're a three-letter acronym?
Well, I think the part of the myth is that they're very risky, right? I think many people remember the damage that mortgage collateral pools did during the financial crisis, and but I also think that risk varies depending on where you are in the securitization capital stack, right? So the AAA debt tranche of a CLO collateral pool, for instance, has all kinds of protections, including a right to claw back the other tranche's distributions and principal to meet the obligations of the AAA debt tranche. So even the equity piece or the equity tranche is more stable than perceived because the CLOs are built on the health of corporations and so reflect the general health of the economy, both of which at this point are pretty solid. So I think the idea of a collateral pool and securitization kind of scares people off. Sounds more complex than it is, but actually the default rates have remained low historically. I think they're somewhere around 1.7% or so today, and they're significantly lower than corporate default rates, which makes sense because you should have a benefit to having a diversified pool of loans, right, rather than investing in single corporate credits. And I think finally, it's probably one of the fixed income strategies that's most suited to a private structure because it requires underwriting, warehousing loans, securitization expertise, deep relationships with CLO debt buyers. And the further down the capital stack you go, the more this is true. So if you're going to invest in the equity piece, very difficult to do if you're not involved in these markets all the time.
So my next question, this is a bit crystal ball stuff, but you mentioned it just a few moments ago when you talked about sort of the evolution of interest rate thinking here to start 2025. We're recording this in February. If we're back to a rising rate world, or maybe not even rising rate, but we just hold steady at the rates that we're at now, right? Do you see things like CLOs as a lifeboat for investors, or are they dead weight now if rates are going to stay higher for longer?
No, I think that they still have a great place in a portfolio. Remember, most of the CLO loans that are underlying the securitizations are floating rate. So you don't have the same kinds of issues that you would have with fixed rate debt. So that's one aspect of it, and I also think that you're not faced with the same kind of duration risk that you would otherwise, as a result, be faced with if you're just sort of buying directional interest rates, if you will. So I think they definitely have a place. Here's a place where you can get sort of attractive yields that relate to the underlying health of the economy rather than where the Fed is going with rates on any particular day or where inflation is going on any particular day.
Pivoting just a little bit in the alternative credit universe, about a year ago, you guys called out private credit. In fact, in one of your blogs, you called it sort of the new cool kid on the block, which certainly a year or 18 months ago, it really was the new kid for a lot of people. Has that cooled at all in 2024 and heading into 2025?
Not really. Sponsors have jumped into the fray, sensing an opportunity, and I guess it makes sense after all. Like, why wouldn't you want permanent capital at higher fees versus liquid capital at lower fees if you're someone that's a manager? I think everyone jumping in at the same time makes us believe that returns will suffer in total. Remember, the opportunity for private credit came largely from the fact that banks were pulling away from providing loans to a certain part of the corporate world, and a large, a set of early adopters stepped in and filled that vacuum, and as such they were able to achieve outsized returns that are probably not sustainable in a more competitive market.
That's interesting. So Wall Street does a very good job of packaging things up and distributing them, right? So exposure to private credit is now available to retail investors in all manners and shapes and forms, right? Does that portend good things for retail or not? I mean, it's been almost exclusively an institutional playground until recently, and now suddenly retail investors are welcome to join private credit.
Yeah, no, I think it's a really useful tool. There are some ETFs now that you can get exposure to the AAA tranche or the BBB tranche for certain providers, and that's debt, right? So that's on the AAA side, it's very, very secure debt. As I mentioned, there are real significant protections there, and a very large pool of loans. And being that high in the capital stack and getting a yield in sort of the mid 6% kind of range is pretty attractive. And the BBBs, I think you're probably getting sort of the mid 8.5% kind of range. So there have been, I think we're seeing more of them. There's a few of them that have pretty significant track records that I would focus more on. But on the debt side, getting exposure to CLO debt is available. Getting exposure to CLO equity is not as available. That's kind of the residual piece after all the securitizations have happened. And it's probably because there are valuation issues with valuing a residual interest in a public vehicle that has to be priced daily.
Right. Tends to end up more in things like closed-end funds or private investments for those reasons. Yeah.
Yes, correct.
Any real risk that you see in private credit today that someone who's new to considering it should probably be on the lookout for?
Well, we discussed this in our latest blog. So, we don't believe investors are getting rewarded for locking up their capital, and the illiquidity premium that used to reward investors for locking up their money for long periods is largely gone, or is not as attractive as it needs to be, and now it's really a cost. As a result, I think you'll see returns that are lower, and many investors that end up being disappointed, not harmed, but disappointed with the ultimate returns over time. And so I don't know if that's a real risk, but that is an area where there is certainly opportunity for disappointment over time.
Are we almost in a bubble in private credit, or is that too maybe inflammatory a word?
I think it's probably too inflammatory. I guess I would look at this from a couple of different perspectives. One, the underlying investments, right? So you'd have to argue that the individual companies, the economy in general has been tremendously resilient in the face of a whole lot of uncertainty over the last few years. And so are those underlying loans that are being made, that are being serviced by corporations, and the results of those businesses doing well or not? And I think you'd have to argue that they're doing pretty well, and that these companies have been resilient in the face of a lot of that uncertainty. If we were to start seeing a significant deterioration in underwriting standards, like that we saw prior to the financial crisis with mortgages, I think that would be a cause for concern. I do think there's probably been, as you get competition, there's been more covenant-light kind of terms that are being competed, when people are competing with each other for certain loans. And that's happening, although I would say that is probably the minority and not the majority. And so right now, I don't see that as a bubble at all. Although again, I would say more people feeding at the trough means that the terms get less and less attractive and the returns get less and less attractive.
Mark, you guys have also talked a lot about venture debt, crypto, other more maybe even more speculative areas than private credit, for example. How do you compare those as a cross-asset or a multi-asset investor?
Well, it's not easy. We're largely looking for fundamental inflections in underlying results of an entity, a company, a security, whatever it might be. So it's hard in asset classes like crypto that have no underlying fundamentals. You really have to rely on ideas like supply-demand dynamics, technical patterns, kind of other non-fundamental ideas. But it is not an easy task. It's frankly why I don't think the crypto yet is in my view, a legitimate asset class, regardless of the fact of how many people want to invest in it or not. It's very difficult for us as investors to wrap ourselves around the idea that you are basically chasing sentiment as a key aspect, again, outside of technicals, other things like that. Obviously, supply is controlled in that circumstance, and demand is based on sentiment. So it's really hard. We would rather spend our time trying to understand the individual specifics of a company, et cetera, rather than trying to forecast, what's going to happen with demand and sentiment with things like crypto.
Getting back to credit, if advisors or investors were to rethink maybe one thing about credit investing this year, what do you think that might be?
Well, I think it would be, and this kind of goes back to my earlier point. I would say that even equity investors need to understand credit issues. It helps you make better investment decisions. And so ignoring what's happening on the credit side, I mentioned default probabilities, credit default, looking at what's happening with credit default swaps. That should lead you to certainly lead you to a better answer in terms of doing your underwriting for even an equity opportunity. So ignoring the signals and the messages that can come from understanding the credit side of the ledger is really a mistake.
Mark, really enjoyed your time today. Thank you for the answers you've given. I like to ask almost everybody this closing question. It goes back to our title for the webcast. What's the biggest credit event you see coming this year?
Well, that's a hard question. I've been saying this for a little while, but I think there's probably got to be some kind of reckoning in the real estate space. Extend and pretend has gone on for a long time. I think the financial engineering that was being done around more distressed properties, more B and C type properties, is been pushed as far as it can, unless rates are going to come down from here. And with rates higher for longer, it's really hard to see how we don't have some defaults there, different investors, equity investors handing the keys to the lenders, et cetera. So I think I would expect a little bit more volatility and a more tumultuous environment, especially for the lower quality real estate properties that have a meaningful amount of leverage.
Mark Scalzo, Chief Investment Officer at Validex Global Investors. Thanks so much for joining us on Credit Events. We'll look forward to having you back again.
Thanks, Rob. Enjoyed it.
Validex Global Investing seeks to invest in companies at every stage of their growth. From startups to publicly traded companies, our research identifies inflection points that have the potential to produce meaningful growth and income for the clients we serve. Investment advisory services are offered through Validus Growth Investors, LLC, DBA Validex Global Investing, Validex or VGI, an SEC-registered investment advisor. No offer is made to buy or sell any security or investment product. This is not a solicitation to invest in any security or any investment product of Validus. Validex does not provide tax or legal advice. Consult with your tax advisor or attorney regarding specific situations. intended for educational purposes only and not intended as individualized advice or a guarantee that you will achieve a desired result. Opinions expressed are subject to change without notice. Investing involves risk, including the potential loss of principal. No investment can guarantee a profit or protect against loss in periods of declining value. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Opinions and projections are as of the date of their first inclusion herein and are subject to change without notice to the reader. As with any analysis of economic and market data, it is important to remember that past performance is no guarantee of future results. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented.